Well, welcome to the Trading Zone. I'm Joe Teague, and with me is
Brian Stullen here from Equity Armor Investments, both of us portfolio managers, alive and well. I decided I'm not, Joe, shaving today until this market goes back up. Quite a volatile day off to a start off of a Labor Day, huh?
Yeah, we'll see. We'll see how long that beard gets, and this might be an interesting week until we get to the jobs number, if then. So it should be interesting. We'll talk about that in a big way as the day goes on. I want to thank everybody for joining. Maybe give people a couple more minutes to get here. If you're watching us on not live, remember we're here usually Monday at 1 Eastern. This is on the Tradier network. This is Trading Zone sponsored by the MIAX.
Yeah, and today's a different day. Obviously, no trading yesterday, so it's a shortened trading week. Makes the expiration cycle in September for you options traders out there come a little bit quicker. Obviously, from the normal expiration, that's the third Friday of the month. Obviously, options are traded every day now, but if you're talking about the bigger volume size option trades that go up, the third Friday comes up pretty quickly now.
So yeah, if you're catching us live, don't forget, put a question in. We'll answer it as the show goes on. Catching us not live, comment and do all of that. We are two former options market makers. Brian, very early adapter to the VIX options, futures and trading. Certainly a pioneer in the field. So we have a wealth of knowledge when it comes to options trading, and certainly a specialty when it comes to volatility and volatility futures and index trading. So that's our background. And now we're portfolio managers, as Brian said. We had a couple mutual funds which we manage, as well as doing a lot of other services for a lot of different types of clients. But I think we've given it enough time here, Brian. Let's jump into the show. Remember, this is the Trading Zone, sponsored by the MIAX. I'm Joe Teague with Brian Stutland. And let's jump into the show. We got a busy week, of course, in the shortened week. September, we're past Labor Day. I always remember from our times on the floor, Brian, you get past Labor Day, that's when volatility starts to rise. You get a weak September very frequently, very volatile October. It's known for that. And then, kind of whatever happens then, the rest of the year is going to follow. So it's very crucial, September. Obviously, for us right now, all eyes are going to be on Friday's jobs report.
Yeah, they certainly are. I mean, like I said, to top off the show here, we're off to a pretty weak trading day here for stocks. So we really want to get into it. We have our big story today, which I'll kind of tease out, is semiconductors. Joe, you mentioned unemployment. We've got to talk about that. So it's a good show to sort of make some correlations. And we have some really good historical data that gets me a little worried, Joe. I'm definitely feeling more worried about this market than normal. It's not that we haven't backed out of the market at all for clients, but I'm just starting to get a little bit more nervous.
Yeah, and this is just typical. There are lots of reasons to be nervous, but typically September happens. You have the summer, dog days of summer, slow trading days, people taking a lot of vacation. September happens, everyone's back to work, their kids are back in school. Something I know now more as a father than when I was a trader. Like, I did not have kids. I'm like, it doesn't make any sense. Just go to work. But it makes a lot of sense now. People are back doing a lot more work. You're after Labor Day. Sometimes people, take some volatility out of the model for that vacation day. Volatility just comes up this week, and we're seeing that in a big week today. Of course, we know the jobs numbers coming on Friday, but there's more news coming on next week. Everyone's talking about the FOMC meeting, but there's also this Apple product launch. I think we're not sleeping on that, Brian.
Yeah, and I think we'll do a good job later in the show to tie that together. I've got a trade here for Apple that I think makes sense at this point, so please stay tuned in on that. Given the big event next Monday on what their product's going to look like. Obviously, everybody's looking for what the buzzword AI is going to be involved with that new product line, and how much they will do to sort of get themselves in the game, given all the other competitors that are out there, making in their generative AI, the latest and greatest. So this will be something to watch on Monday. And we wanted to give a trade ahead of that simply because, when you look at what's going to take place, what it's done in the past, that happens on Monday before we jump back on our show next week. I would at least want to have an idea of what to do there.
Yeah, so let's head into it. Jobs Friday, 15 days till the FOMC, Apple product launch September 9th. We will be hitting all those in a big way. But like we usually do, we'll start off looking at the current scope of volatility. This is the skew index, something we look at every week. Just to have a little track in, we think of the skew index as a little bit of a leading indicator on volatility. It's oftentimes ahead of where the volatility indexes are. This is very critical for us to look at, and it's kind of poking its head above water here, Brian.
Yeah, it's started to kind of make higher lows recently here, and you can see that today even moving up a little bit more. So put buyers coming back in the market, freaking out a little bit and trying to look for some portfolio protection, and that's why the skew value is going up, because this means implied volatility, the amount of premium somebody is willing to pay on a downside put is increasing relative to gaining some upside optionality exposure through the call. So this is something we're watching, and is a little concerning. That it's kind of been on the rise here. Volatility itself, the VIX really popping hard today. Joe, you mentioned this is seasonality, a time where we do see volatility pops, but obviously a move of a market of greater than 1% gets people worried that the VIX and premiums options, the VIX should sit above 16, because 16 kind of represents that 1% daily move kind of thing.
Yeah, and to be honest with you, something we talked about, like this area here is kind of where I expected us to be living after we had this pop, right? I expected the skew to stay elevated, way off of that recent high, but stay elevated and channel there. It was surprising to see it trade back here. Maybe that was just kind of a complacent signal. People got off sides, selling puts perhaps, or just essentially offside on volatility. We'll wait and see if that turns out to be the case. But I think, at least in the short term, that was kind of like the market was just got too far to see volatility come so down so far so quickly. We'll wait and see.
Yeah, I mean, our models haven't given us a buy signal yet on what this is doing for VIX futures themselves, but we are trying to stay hedged. Like I said, I have some concern. I want to use options and optionality in this kind of market environment.
Yeah, absolutely. Speaking of optionalities and volatilities, you brought this up earlier. We got the VIX term structure kind of holding steady. Like, you got a new normal here where, we got September being the front month. We have October is the big month there. This is the current spot here where here's where we are now. So October, it's elevated. That's been elevated. We should be expecting that should be the normal, where we get a little hump in this curve with the election happening in November. So the October VIX future is going to capture the November implied volatility in the S&P 500. So you should expect this little hump here. So we just have to live with this normal. It is interesting, of course, to see the cash above the front month, Brian. That is something we saw ahead of Yen Mageddon. That's something that was kind of leading into that. So just something that's a little curious to me.
Yeah, I think it makes sense. I mean, look, we got the jobs number coming up on Friday, so people are probably, owning some optionality for market movement to occur. When you look at the VIX futures curve, it really is sitting right in the middle between where it was versus 2 months ago. So it feels like we've kind of gotten back to this mean reversion, and maybe this is going to be the new norm. Maybe the VIX level for normality is 16, 17 now on the VIX. And when it gets down to 13, let's say, it's a buy. When it gets above 20, it's a sell. So it just seems like this is the new range, and it's sitting right in the middle. So I think it could go either way. And we probably, like I said, teased earlier in the show, we have some historical data maybe to support that, why it could go one way or the other.
Yeah, but being back to being the new normal, we should remember the Fed's about to go into an easing cycle. It had been in a tightening cycle. And it's counterintuitive, but in the tightening cycles, that goes hand in hand with a strong economy. Stocks do well in a strong economy. Volatility is low in a tightening cycle. The Fed's about to go into an easing cycle. Historically, that's been a sign that volatility is about to go on the rise. Fed starts to cut, volatility goes higher. We should expect that the new normal volatility higher as the Fed's easing, because really the range of possibilities is higher right now. This weakening economy can kind of trip over itself and make things harder for itself and just create more volatility we don't see now. We could see that in 2 weeks.
Yeah, and I think when these cycles that you're talking about are really interesting because they do historically for volatility, because it's such a mean reversion thing, and this is why it's important to sort of pay attention to this section of the show, is there really are these like four quadrants of volatility that we exist in based on where interest rates are, based on where the economic cycle is. And you talk about one of them where historically this has led to serious volatility pops in the market. And those usually come when there's a downdraft. So this is something to pay attention and be aware of.
Yeah, and we're going to talk about that in a big way about later in the show, like with this Fed cycle and the economic cycle. Is the Fed lining up with the economy? I think that's going to go a long ways in telling us which way this chart's going to turn out. We're really at a crucial spot here, Brian. We're hanging on by a thread here onto this trend line. I would say it's broken through. I would say we're below this trend line. And it doesn't look great. And kind of what's worse, what leads this for me, something we talk about a lot, the AI trade has been leading the market. Semiconductors are leading us lower here, and it's really starting to look like a dreaded head and shoulders top.
Yeah, that's the one thing that's been, well, there's a couple things that are concerning me. That's one of them, right? So the semis are leading us lower. Historically, those have been market leaders. It's fallen back out of that uptrend line area. The S&P barely hanging in there. Now the S&P is trading about 10 handles, 10 points above the lows it made a few days ago, I believe August 28th, 29th. So that's still somewhat positive, but the leaders in the market dragging lower and getting this formation pattern that's occurring, should the SMH sort of hit that lower red channel area, that could really bring the market lower. Now, remember, NVIDIA is a bigger weight in the S&P, 6%, right? We talked about that. Earnings, since it's come out with its earnings last week, just, an update. The stock has fallen short lately here, and the rest of the sort of sector is following along with it. Now, today, you're seeing massive drops in a lot of names in the semiconductor industry, and it's starting to get a little concerning for me.
Yeah, and you got Supermicro having a lot of trouble lately. Intel, continuing at their job cuts. So this is kind of troubling. And the reason why this is a leading indicator, of course, it's kind of leading to the economy broadly. If people are hiring new people, they'll be buying more computers, buying more desktops. If people are expanding their business, they'll be buying more, chips essentially. So if the economy is growing 6 months from now, the semiconductors will be growing today. So that's why it's really crucial to watch this as a leading indicator for me.
Yeah, and when you take a look at this formation, you mentioned the head and shoulders top. So, watch obviously that 210 level or so on the SMH. That's what I'm kind of paying attention to see if we break down below there and head into that red channel.
So, what might break the difference here? What is the tiebreaker? Is this going to turn around? It did turn around earlier in August. Can we do that again? Well, a lot of people are talking about the Fed cutting this week, and now we've gotten back to this yield curve. This has been a recession predictor, basically 100%. Going back, when the yield curve inverts like this, you can see a recession. And we've also unfortunately seen the longer the inversion, it's correlated with a deeper recession. So it's a couple things we've had. We've had a very long inversion, and we've had very inverted. So this could be a troubling sign. Now, while that's the case, the recession doesn't actually come until this yield curve reverts. It goes back to its normal shape of a positive yield curve. We are very, very close to having that happen, where we see the twos trade below the tens in this case. And yeah, we're very close to seeing a positive yield curve, which would mean a recession is about 6 months to 9 months away.
Yeah, I mean, the only positive to come out of this is for the banks. They like obviously having a yield curve in which the 10-year is more, where they can borrow from the Fed discount window or commercial lending, commercial paper notes, and then lend it out at a higher rate on the back end and capture that spread. So that's moving more favorably towards them. It's probably why you're seeing value stocks start to kind of hang in there because so much of that is made up of the financials. But when you look at this as an indicator, it's concerning why this is happening, why this curve is going to the point where it is. And the reason behind it is if we have weaker unemployment rate, if we have a slower economy and the Fed has to cut rates, now the front end of the curve is dropping below the back end, and it's a need for liquidity to come back into the system.
Yeah. The market's just saying, hey, the economy is slowing down. These twos need to go lower. That's historically that's been why this curve flattens out and goes positive. So we'll see if that plays out to form. But if you throw in the unemployment rate, which is really what it's going to come down to, you can see pretty predictably after this, after we get this inversion, you got this 6 months later, you see this, going up, going up right there again. You know the story. So when we get back above positive, you can see this unemployment rising and ticking up about 6 months down the line.
Yeah, the only time it really didn't play out was 1998, and basically the Fed came in there and cut rates more than expected, than people expected. That might need to happen again, where the Fed rate cut happens more than market expectations in order to get the liquidity back into the system. And in 98, you obviously had the tech boom. So maybe we have that again. Maybe we have the generative AI boom, similar to the tech boom, which is sort of revolutionary, in technology, and combine that with the Fed cutting more than people expected. And maybe that kind of hangs things in there and gets unemployment rate to start heading lower again. But if we don't, look at all these times. These are about 7, right, Joe? 6 out of the 7 resulted, when this yield curve went back to positive, resulted in unemployment rate going up significantly after that and a recession hitting. So 98, they kind of held off for 3 more years. So this market, to me, feels like it's going to break one way or the other. It almost feels like the only way I want to own this market is through maybe some out of the money calls where I get to just keep participating in up on the upside, or the market falls apart and all I risk was the premium on the calls, and I'll figure out another time and level to get back in this market.
Yeah, it makes sense to have that on, to be in this market with protection. Because I really do see 2 potential very different outcomes in 2007 and 1998, and those were dramatically different returns for the market, and really would be painful not to be in the market in 1998 and 1999. And obviously it was very painful in 2007 and 2008 to be in the market. So it makes a lot of sense to be in the market with protection right now, given where we are in the market. I think 2007 98 so similar to right now. We got the September rate cut happening after the Jackson Hole Symposium. In 98, it just happened the Fed was early on the recession. They were early on the job losses, and they just kind of added some liquidity that the economy didn't need. It grew the bubble even further. In 2007, it was the Fed was late. The Fed should have cut earlier. The damage was already starting to happen. And that, popped the whole housing bubble because maybe it was inevitable to pop anyways, but it just caused the whole thing to collapse disastrously. So I think both situations are certainly possible. Really interested to see what will happen on Friday. Now, that said, I do think there is something a little bit different, Brian, between those 2 years and now. Yes, the AI revolution is very interesting, very good parallel to 2007. I think the job losses, as you can see here, we're the blue right now. The red is 2007's job losses. That kind of looks similar right there. That's certainly kind of troubling. But I think the difference right now, kind of going untalked about in the economy, is the amount of money the government's still spending. We have COVID era spending still being added to the economy. Like, we're adding $7 trillion a year or something to our debt. Maybe that's a problem, a big problem 5-10 years from now, but for the next quarter, it's probably going to be really good for the GDP, and maybe that'll keep job losses at a minimum.
Yeah, so government spending basically is acting somewhat as a stimulant. So you combine that we already have in place, right? If the Fed cuts aggressively, I think the critical thing will then be those October, November job unemployment report. And then on top of the November unemployment report, you have an election. So that's probably why we mentioned earlier in the show why that OCC future, which is tied to November S&P options, is bid a little bit higher because people are playing and watching this time frame. I think I will be watching that as well and trying to figure out ways for our clients how to play it and for myself on how to play it best, because all that is indicating that these next 2 months or 3 months of job numbers are super critical to see where the economy is heading. And then probably ultimately, who knows, maybe a 20 or 30% move directionally in the broader markets off of that, whether that's lower in a recession or significantly higher if we've kind of staved off that issue.
Yeah. And, it might be the case we have 3 months of decent sideways jobs numbers. That kind of would go in line with back what we were saying when the yield curve reverts to its normal shape. About 6 months later, then you see the job loss to start to accumulate. That also will coincide with when we have a first-year president. Doesn't matter who wins, there's going to be a first-year president. And sometimes you see some of that damage happening early in term, so there's time to turn it around before the midterm elections. So that kind of goes all together, and with the political timing.
Sure. Yeah. So what do we got here? Is this, here's a stock. We have a big event coming up Monday. Is this one thing that can help save the market, Joe? Or do you think Apple is destined to head with the rest of everything else headed lower? Or is this going to be a positive thing next week?
This could be a big signal that it's looking more like 98 if Apple has a really positive result from their product launch. So we know Apple, we can remember, Steve Jobs having these big presentations and, everyone's excited and they're clapping. And then, he says, oh, wait, there's just one more thing. And then, boom, like he brings out like the iPad, or he brings out, the iPhone, or all these amazing things that Apple's come out with. We've had a lot of talk about this AI revolution. We've had a lot of talk about how many chips people are buying. We've had, people are talking about these language models that are basically free. No one's spending any money on it. We've not seen anything from the AI that has really added to the bottom line of all these big companies. So this is a huge, big test. Apple is saying, we got this new thing. People are going to spend money for it. And we're going to find out, is it true? Are people going to pay money for the AI?
Yeah. And look, historically on the Apple launch dates, there's been more times where the stock has been down after that than it has been up. So there is some historical things going against it for that. And that makes me a little bit worried, which is why I want to outline a hedge sort of strategy with the stock. But, to your point, Joe, if it comes out positive and the stock turns higher, if I look at this chart, there's no reason why the stock can't make an all-time high and move to that $240 level. So I'm not saying, hey, get out. I'm worried with everything else in the market just yet. I just want to use some, risk control metrics here to sort of figure out a way to navigate through this event that we'll have on Monday. And since the event is Monday, we're trying to lay it out now so that if I were to put this on, I would want to put this on, at some point throughout this week here.
All right, let's take a look at it.
All right, so looking at Apple, trading around 224. Joe, we were looking at this November expiration, volatility's bid. This will give us a chance to participate. Apple will have an earnings event, obviously, before this expires, along with the event coming up on Saturday. So you kind of get a 2-for-1 deal here. And I'd be looking to buy the November 210-190 put spread, pay about $3 for it. To me, that's pretty cheap, actually. I mean, 1.5% that I basically have to, if I'm wrong, okay, I'm going to miss out on the first 1.5% up move because I'll factor in the loss that I paid for the put spread in doing so. But I'm willing to sort of give that up on this kind of stock to get that protection between that 210 mark and that 190 mark, 190, where this put spread would go to $20. So it's quite a significant, payout here to the downside. And so that's why I think this gives me enough level of protection. That $200 area seems to be a key level of support. And if we were to sort of break that, I think 190 would be in the cards. And then that put spread, realizes its full amount. And I get to kind of step back from the market, so to speak, by having that put spread on against a long stock position, which, we have on for clients, full disclosure, and it's a stock we like, and I like, but it's one where I want to kind of add some protection here, and I can do it kind of, to me, it seems kind of cheap, right, Joe?
Yeah. So you're spending 1.5%. You're protected in that little red shaded area, right? You got 10% protection at the downside. And I think that's a very spot on protection right here for that time period. Not expecting, don't need protection for it to crater all the way down to 140 or something. We don't think that's in the cards. But if it's a soft launch, people, saying, hey, this recent rip after this announcement, people got too excited about this phone. It's not going to live up to the expectations. Which we saw 12 of the last 17 product launches have been a disappointment. If it just pulls back a little bit, you're absolutely covered. But like I said, if it's a banger, if people are waiting outside these Apple stores, putting up tents, I think you'll be covered to the upside too.
Yeah, and I think when you look at it, you're drawing a head and shoulders on the semiconductors. Maybe you could draw one out right here, Joe. This is why I'm buying this put spread here. If you look at this movement, okay, now let's say we break 210. This is why I'm owning that put. Then we head lower to break that sort of neckline, and I want that protection all the way down to 190. But these are, by the way, Joe, these are trade alerts. It's really cool. Actually, Equity Armor Investments coming up very soon. You'll have to keep tuning in. Is going to offer our weekly trades, Joe, because we've been so successful in how well we've played those out for our own trades we're devising here on this trading zone. Equity Armor is going to offer trade alerts as a subscription for people where you'll be able to get it and get alerted on these trades. So if you happen to miss our show or whatever, you can get notified and put these on. And I think they've been pretty valuable in the past. So hopefully we can continue to do a good job with our own, personal opinions about this stuff.
Okay. Well, I think that'll do us for this week. I want to thank everybody for tuning in. We're here every Monday, usually at 1 Eastern. I'm Joe Teague of Equity Armor Investments.
I'm Brian Stutland, Portfolio Manager, Equity Armor Investments. Catch you next week, every Monday, 1 p.m. Eastern. Happy you tuned in. We'll look forward to seeing you next week.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by SIBO, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.